Hello and welcome to the Business Standard Morning Show. I'm Vinu Sandhu. It's the 9th of June 2023 and here are the top stories for the day. The Reserve Bank of India's Monetary Policy Committee has decided to keep policy repo rate unchanged for the second consecutive time. While Governor Shaktikanta Das appeared bullish on growth and also lowered inflation projections marginally, he remained cautious about external factors that could affect both inflation and GDP growth going forward. So will the pause by RBI lead to a pivot? Bhaswar Kumar speaks to experts to bring you the answers.
The Reserve Bank of India's six-member Monetary Policy Committee on June 8th unanimously approved keeping the benchmark lending rates unchanged for a second straight time. According to RBI Governor Shaktikanta Das, the decision to keep the policy repo rate unchanged at 6.5% was taken keeping in mind that the MPC's cumulative rate hike of 250 basis points was transmitting through the economy and its full impact would likely keep inflationary pressures contained in coming months. Das had left the door open for the MPC to hike rates in future meetings, even as it has pressed the pause button on April 6th after hiking the repo rate by 250 basis points since May 2022. In its latest meeting, the MPC also decided by a majority of 5 out of 6 to continue with its stance of withdrawal of accommodation. The MPC took this decision to ensure that inflation progressively aligns with the target while supporting growth. The RBI got elbow room to maintain an extended pause on policy rates after the retail inflation rate in April fell to an 18-month low on the back of a high base and easing price pressures across categories. The Consumer Price Index-based inflation stood at 4.7% in April, as against 5.66% the previous month. The headline inflation rate stayed within the RBI's upper tolerance limit for the second consecutive month, thanks to a moderation in prices of food, fuel, clothing, and services. The question now is, will the pause by the RBI lead to a pivot? A pivot would mean that rates have peaked and that they are likely to be cut in the future. It would also involve the RBI reversing its existing monetary policy stance. So, what do experts think about the likelihood of a pivot in the coming MPC meetings?
Well, we expect the pivot to start towards the last quarter of this fiscal year. And before, I think they cut interest rates in the January to March quarter, which is our expectation, I think they will also announce a change of stance.
If inflation is going to peak in this current cycle at say 5.4% in Q3 of this year, it looks very unlikely that at this particular point of time, the RBI would probably turn the pause to a pivot and start lowering the rates. So if at all there is going to be a lowering of rates, again based on data on the way in which data looks, it could be only in the fourth quarter of the financial year.
While we will have to wait and watch to find out whether a pivot actually occurs, in the meantime, there are several factors that could delay such a decision. During the latest MPC meeting, retail price inflation for 2023-24 was cut down slightly to 5.1% from 5.2% earlier, on the assumption of a normal monsoon. While the MPC said that the India Meteorological Department's normal monsoon forecast argued well for Kharif crops, it also cautioned that the monsoon's spatial and temporal distribution would need to be closely monitored. The MPC also said that while crude oil prices had eased, the outlook remained uncertain. Just days before the MPC meeting ended, Saudi Arabia, the OPEC cartel's dominant member, said it would make deep production cuts of 1 million barrels per day starting from July. With regard to economic growth for the current financial year, the MPC retained the earlier projection of 6.5%. The MPC said higher Rabi crop production in 2022-23, the expected normal monsoon, and the sustained buoyancy in services should support private consumption and overall economic activity in the current year. However, it cautioned that weak external demand, geo-economic fragmentation, and protracted geopolitical tensions posed risks to the outlook. So, how does experts think these factors could affect any potential decision to go for a pivot or not?
Well, I don't expect the crude oil prices to rise too much unless there is a big geopolitical event, because global growth is slowing, demand is slowing, so crude prices will be less than last year. I think the worry is on the monsoon front, because there could be a risk to the overall precipitation from El Nino if it does play out. I think so that risk still remains, and food is a large component of our consumer basket. So in that sense, I think food inflation and the risk of monsoon, I think, is critical to me at this juncture.
The one major risk factor which is there today, which is holding back the Reserve Bank of India from lowering rates, is the possible effect of the El Nino on monsoon and on the agricultural crop. And we have seen also in the past that any kind of a crop failure, not specifically overall crops failing, but even maybe pulses failing, oilseeds failing, has the potential to increase inflation, which in turn could actually also justify a further increase in rates in case we do reach that kind of situation. But we can assume that the rate hike cycle is more or less done with. And the caution which we're talking of is only because of a very, very adverse situation arising. I don't think personally that it's going to be that bad. But yes, there could be a blip here and there which could keep inflation in this region of 5.5%, 6%, which in turn could mean even a more prolonged pause or no cut during the entire financial year.
To conclude, the RBI could opt for a pivot during Q4 FY24 if the monsoon is normal. But it may also have to look out for inflationary pressure arising from the possibility of increased government expenditure due to the upcoming assembly and general elections.
She'll soon be quoted on the front page. Business Standard.
Governor Shaktikanta Das recently acknowledged the role played by banks in supporting the economy and maintaining resilience. But he also sounded a note of caution and asked public sector banks to further strengthen governance. This comes at a time when the financial health of government-run banks has improved remarkably. So is there reason to worry? And are public sector banks under pressure? Tushar Verma scans the books for the answers.
In March this year, when 3 US banks and a prominent Swiss lender collapsed, ripples were felt across the globe, spooking governments and industries alike. India, although safely placed, could not ignore it.
Recent events in the banking landscape of the United States and Europe suggest that risks for an individual bank could crop up from segments of its balance sheet which might have been considered relatively safer. Hence, we expect the management and board of directors of each bank to continually assess the financial risks and focus on building up adequate capital and liquidity buffers even beyond the minimum regulatory requirements.
The government, meanwhile, has highlighted several aspects to say that a similar meltdown was highly unlikely in India. Most domestic banks, both private and government, are in pink health. Asset quality of public sector banks has improved significantly over the years. Their gross NPA ratio has declined from the peak of 14.6% in March 2018 to 5.53% in December 2022, and close to 63% of the total deposits are held with these state-run banks. But at the same time, the banking regulator has been emphasizing on improving governance of PSBs and regulatory and financial transparency. So, are PSBs facing some troubles?
NIM will be under pressure for all the banks because as the bulk of the deposit portfolio get repriced, then the NIM will be under pressure, which has not yet been the case. As far as public sector banks are concerned, if you look at the two sets of private banks and public sector banks, the difference between deposit growth and credit growth is far higher than in public sector bank than the private banks. So, for instance, one public sector bank is deposit growth is minus, but credit growth is some 20-odd%. So certainly, yes, in that sense, they would need to attract more deposits and pay higher. That's an issue.
Governor Shaktikanta Das has emphasized on greater involvement of independent directors in board of banks. He said that independent directors should have loyalty only towards the bank and should be free of management and controlling shareholders. This comment, which comes after the top brass of the RBI recently held a conference on sustainability with heads of banks, suggests that public sector banks should do more to improve transparency and governance.
If you have to define, the role of independent directors in the public, banking system to begin with, and then public sector particularly, that there was more participation on compliance matters. Gradually we will realize that the board and particularly the independent directors have to get into the strategy aspect, the business plan aspect more and more, risk management frameworks a little more closely than it was earlier, much more closely than it was earlier. So to that extent, I do sort of support that observation. Public sector, the whole appointment of directors, are the board NRCs in a position to really appoint or take new independent directors? Those questions have always come up.
In FY23, 5 largest public sector banks received much higher deposits than private sector banks. The total deposit with these PSBs stood at a massive 8.43 trillion rupees, of which SBI alone received 3.72 trillion rupees. At the same time, top 5 private sector banks together registered a total deposit of 6.6 trillion rupees in FY23. A key point to note, however, is that the rate of growth for PSBs is skewed. While credit growth was 15% year-on-year in FY23, the deposit growth rate was 9.58%. So, will PSBs come under pressure in the near future?
When the rate hikes were happening, we saw almost, over 2 years period, we saw a hike of 250 basis points. Now, the transmission of those rates, that happened more on the lending side. Deposits, however, took a little longer. Deposit rate hikes, wasn't in keeping with that lending kind of, let's say, transmission. Now, this is going to certainly create asset liability management situation. So what you're really doing is you're funding from very short-term funds. If you're borrowing from money markets or interbank, then you are actually borrowing short-term funds and applying them for long-term. Now, what may happen is, when the rate reductions take place, the NIM will certainly come under pressure.
Another key thing that might prove troublesome for PSBs is the rebound cycle of non-performing assets.
As we speak, both the gross non-performing assets as well as the net have come down dramatically. Other part of it, the so-called provision coverage ratio, the PCR, is pretty high. But have we seen the end of it, and now the cycle, will it turn around? Well, as far as the corporate assets are concerned, I don't think there is any concern. But as far as retail assets are concerned, I see there are certain concerns purely because of the fact that the interest rates have gone up. About 44% of all bank loans are now the external benchmark rate. All MSME loans are linked to external benchmark rate. So my understanding is this: some banks are seeing the SMAs are being created.
Experts believe that net interest margins of public sector banks are bound to come under pressure, and going forward, the challenge before the lenders will be to strike a balance between credit and deposit growth.
Most bank stocks meanwhile fell on Thursday. Equity markets also nursed losses even as the RBI kept the repo rate unchanged at 6.5%. Going ahead, analysts see 2 key factors moving the markets in the near term. What are these triggers, and what should investors' strategy be? Nikita Vasisht brings you the answers in our next report.
Dalal Street indices dropped to 1% on June 8, even as the Reserve Bank of India kept the repo rate unchanged at 6.5% for a second straight policy. The benchmark S&P BSE Sensex gyrated 532 points intraday, while the Nifty 50 swung within a range of 162 points. Going forward, analysts say the market's trajectory from here on will depend on the progress of the monsoon and consumption trends.
most of the domestic events done, which is the Q4 quarterly season and the monetary policy. The major event to watch out is the progress on monsoon, number one. Number two, secondly, there have been signs of slowdown in the consumer spending, which was quite evident in the Q4. This thing, quarterly results. That again will be watched extremely closely.
Globally, nervousness is creeping in the markets ahead of the US Federal Reserve's policy meeting next week.
The market is looking for a correction. Like technically, also if you look at the derivative data, 44,500 was actually a strong resistance for the Bank Nifty. Earlier, we have fallen from that level, and today again 44,500 having highest call of open interest. That's why 45,500 acted as a resistance. And another reason is that we are heading towards price policy. And today we have a job data of USA. So market is fearing that job data will remain strong and we may see some hawkishness.
Against this, what should investors do? Is it prudent to remain a fence-sitter for now? Meena of Swastika InvestMart says investors should use the intermittent corrections to enter the market.
The long-term story is still intact. So any correction, any 5% correction will be good buying opportunity in the market if it comes. Because we haven't seen 5% correction for the long time in the market. So we have seen some consolidation. But now today market is showing that it is ready for a profit booking or correction before it hits new all-time high. So maybe in late June or maybe in July we will hit all-time high. But for timing in near term for a week or 15 days, market may see some profit booking or consolidation.
Thus, despite the RBI governor's less hawkish tone this time, markets could see some correction as fundamental and technical indicators signal a breather in the recent upswing. Today, on June 9, global cues and stock-specific moves will dictate the market moves.
He's making plans for an early retirement. Business Standard.
Staying with the markets, the shares of computer chip designer Nvidia have skyrocketed in the last 1 year, pushing the company's valuation beyond the $1 trillion mark. With this, Nvidia has joined the league of tech giants like Apple, Amazon, and Microsoft. Nvidia is the largest GPU manufacturer in the world. Tushar Verma has more on it.
Central Processing Units, or CPUs, have long been the primary competition engine for everyday computers and smart devices. Higher the processing power, the faster the computer usually is. We have known software engineers asking for powerful CPUs to run complex programs without lag and delay. Now, organizations have begun using graphics processing units, or GPUs, in a broad range of applications like gaming, content creation, machine learning, and more. They are designed to accelerate computer graphics workloads. Until 2 decades ago, GPUs were unheard of. It's the boom in the video games market that led to the development of GPUs. Developers realized the need for a dedicated processor, like a cousin of CPUs, solely for the processing of 2D and 3D graphics of video games. Nvidia is credited with introducing the first ever GPU to the market in 1999. It was called GeForce 256. With the turn of the century, GPUs gained importance with the development of expansive PC games and higher resolution content in HD and 4K. It is now critical for content creation such as video editing, graphic designing, game design, and even in the field of engineering and architecture. Nvidia is the leader and the most dominant GPU designer. It pioneered consumer-facing GPUs and now expanding into GPUs for data centers, AI, and machine learning. In the past few years, PC and laptop sales have fallen. In 2022, PC shipments fell by 16%. Gartner reported a 28.5% year-on-year drop in PC sales in the last quarter of 2022. Yet, Nvidia went on to achieve a massive $1 trillion market cap. Last year, its CEO said that Nvidia has $11 billion worth of orders lined up just for the automotive industry. The orders are for GPU for high-tech driving systems. In February this year, the company reported revenue of $27 billion. Clearly, the chip maker is not only diversifying into several areas, but is also strong on finances. Supply chains across the globe were disrupted because of worldwide restrictions during COVID-19 pandemic. Among the causes of shortage was an apparent hoarding of high-quality GPUs by cryptocurrency miners. According to a New York University report, 19% of the world's GPU production in 2020 was used for mining Ether, a cryptocurrency. To counter this, Nvidia had come out with tailor-made crypto mining processors. However, that wasn't enough to mitigate the global GPU chip shortage. Nvidia is making aggressive expansion in the GPU space. It recently announced new system architecture for GPUs built in collaboration with Quantum Machines, a company leading quantum computing research. It is capable of extremely low latency quantum classical computing that can be used for giant AI programs.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
A well-known analyst recently said that what Nvidia is to AI is almost like what Intel was to PCs. Well, that's all for today. For more news and analysis, please log into our website business-standard.com. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.